Finance management. Finance management is the strategic planning, organizing, controlling, and monitoring of financial resources to achieve organizational goals efficiently and effectively. It is crucial for businesses of all sizes and also relevant in personal finance contexts. Finance management encompasses several key functions, namely financial planning and forecasting, budgeting, capital structure management, working capital management, investment decisions, finance control, risk management and financial reporting, financial planning and forecasting. Financial planning forms the core of finance management, establishing a clear path to reach both immediate and long-term financial objectives. It involves setting financial goals and crafting strategies that support broader organizational or personal ambitions. For businesses, these plans may include expanding operations, introducing new products, or upgrading technology. Forecasting involves projecting future financial performance based on historical data, market trends, and economic indicators. Finance managers use methods like regression analysis, scenario planning, and sensitivity analysis to predict revenue, expenses, cash flow, and profitability. Forecasting allows businesses to anticipate future funding needs and prepare for uncertainties. Budgeting. Budgeting helps in resource allocation, guiding an organization on how to prioritize spending. Different types of budgets exist, such as operating budgets, which cover daily expenses, and capital budgets, which focus on long-term investment needs. Variance analysis is a critical part of budgeting. By comparing actual spending against budgeted amounts, finance managers can identify discrepancies, understand their causes, and make adjustments. For instance, if marketing expenses are higher than budgeted, the team may explore cost-cutting in other areas or reassess campaign goals. Capital structure management. Capital structure refers to how a company finances its operations and growth through a mix of debt and equity. The right balance between debt and equity reduces the cost of capital and maximizes value to shareholders. Debt financing allows companies to retain full ownership but involves interest payments and repayment obligations, which can impact cash flow. Equity financing, on the other hand, doesn't require repayment but dilutes ownership. Decisions on capital structure are strategic, as they impact financial flexibility and risk exposure. Companies often aim for a weighted average cost of capital that balances these considerations, optimizing overall financial health. Working capital management. Working capital is essential for day-to-day operations, ensuring a company can meet its short-term obligations. Proper management involves overseeing accounts receivable, that is money owed by customers, accounts payable, that is money owed to suppliers, and inventory levels. Cash conversion cycle measures the time it takes for cash to circulate through the company, from paying suppliers to collecting payment from customers. A shorter CCC indicates efficient cash flow management, critical for businesses with tight cash reserves. Tools like just-in-time inventory, dynamic discounting, and flexible credit terms help improve working capital management and maintain liquidity. Investment decisions. Capital budgeting assesses potential investments, analyzing projects based on projected cash flows, risks, and return on investment. Common methods for evaluation include net present value, internal rate of return, and payback period. Investment decisions align with strategic goals. For instance, a tech company might invest in research and development for product innovation, while a retail business might focus on expanding stores. Effective capital budgeting helps a business allocate resources where they are likely to yield the best returns, balancing growth and risk. Financial control. Financial control systems monitor and regulate financial activities, ensuring alignment with financial goals. These systems include auditing practices, internal controls, and policies governing spending and investment. Performance monitoring involves analyzing financial metrics such as profitability ratios, efficiency ratios, and leverage ratios. Tools like key performance indicators and balanced scorecards help finance managers track performance and make necessary adjustments. A strong control environment reduces the risk of fraud, errors, and inefficiencies, ensuring that financial resources are used effectively and in compliance with regulations. Risk management. Risk identification and assessment identify potential financial risks, including credit risk, liquidity risk, market risk, and operational risk. By analyzing past incidents and current conditions, finance managers assess the probability and impact of these risks. Risk mitigation strategies include insurance policies to transfer certain risks, diversification of investments to spread risk, and hedging techniques like futures contracts to protect against price fluctuations. Contingency planning is part of risk management, ensuring the organization is prepared for unforeseen circumstances. Financial risk management protects the organization's assets and sustains financial stability, especially in volatile markets. Financial reporting. Financial statements such as balance sheets, income statements, and cash flow statements provide a comprehensive view of a company's financial health. These reports are essential for stakeholders, including investors, management, and regulatory authorities. Compliance and transparency are fundamental to financial reporting, especially for publicly traded companies. Financial reports must follow accounting standards like generally accepted accounting principles or international financial reporting standards to ensure accuracy and comparability. Financial reporting also supports decision-making by highlighting trends in revenue, costs, and profitability. For example, if a company notices declining profit margins, it might decide to reduce costs or reassess pricing strategies. Importance of finance management in business and personal contexts. Finance management is about making strategic, informed decisions that drive stability, growth, and value. In a business setting, effective finance management is essential for navigating complex financial landscapes and ensuring sustainable success. By carefully managing resources, businesses can achieve their objectives without the risks of overspending or leaving valuable assets underutilized. This optimized use of resources enables companies to operate more efficiently, reaching targets and delivering better outcomes across various functions. In addition to resource optimization, finance management plays a pivotal role in enhancing profitability. Through meticulous cost analysis and budgeting, finance managers can identify areas where expenses can be minimized while revenue opportunities are maximized. This approach doesn't just increase profit margins, it also allows businesses to reinvest in strategic areas that foster growth and innovation, ultimately creating a stronger foundation for future expansion. Finance management is key to ensuring long-term stability, enabling companies to weather economic uncertainties by managing capital structure, controlling working capital, and planning finances strategically. This proactive approach creates a stable foundation that helps businesses adapt to shifting market conditions. Additionally, finance management supports a company's strategic goals, such as expansion, innovation, and maximizing shareholder value. By effectively allocating and monitoring resources, finance management aligns financial decisions with broader organizational objectives, driving growth and sustaining competitive advantage.